Well, after looking unbreakable for all of 2024, markets are finally starting to crack. Hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday, the 23rd of April 2024. And before I get started, you do need to be aware that whatever I say is general advice only. It does not consider your personal financial circumstances, and you have to decide whether it's appropriate for you. So on Friday, we saw a really sort of worrying escalation to a bit of a conflict in the Middle East. We saw, direct attack from Israel on Iran, follows a direct attack from Iran on Israel, which follows, a series of other actions between the two nations. They've been going back and forth for a long time, but obviously it's heated up a lot with the issues going on in that part of the world at the moment. And it was really concerning for markets on Friday. At least one of these nations, possibly both of these nations, perhaps have nuclear weapons, and it's a worrying potential conflict for pretty much everyone on Earth. That could turn into a huge humanitarian tragedy were it to escalate. Absolutely, probably one of the most worrying conflicts of recent memory. It would also be probably devastating for markets if it was to go into a full-scale conflict. Already just with the sort of small bit of escalation we saw oil prices skyrocketing, we saw share markets falling very strongly, and I think everyone was sort of panicking a little bit during Friday's session as our market sort of ended up falling sort of over 2% at the lows there. As the day wore on, it did become clear that both sides didn't really want to escalate things further, and so markets did bounce back a little bit. But I do think it's just worth keeping an eye on what's going on in that part of the world, and sort of considering anything oil related or anything related to that part of the world, just considering how it might affect your trades or investments. The main story, though, is inflation and interest rates. So obviously we saw the US inflation numbers for March, and they came in stronger than expected. Comes after February's numbers were stronger than expected, and January's numbers were stronger than expected. I've come here every week and I've said that US data is stronger than expected, and it's not this year. It's not pointed towards inflation continuing to fall. So for markets to really get in their head that there's going to be 3 to 5 rate cuts this year, I think they dramatically sort of overestimated and obviously probably overbought due to that overestimation. And most of the selling really we've seen across the past fortnight has been some of that being unwound. Look, I still think there's a fair chance that we do see a rate cut this year. It might only be one. But unless data continues to weaken, there is actually a real possibility of another rate rise, and that would be very, very devastating for markets. Now, rate cuts, rate rises aside, if rates hold at their current levels, shares look extremely expensive. You can justify, the rally that we've seen since October, partly by earnings growth, but not entirely. A lot of that rally has to have been sort of priced in, or has to have come from rate cuts being priced in, and those rate cuts can no longer be reliably priced in. So share prices do look very expensive even after the selling that we've seen so far. So I do want to sort of suggest, keep an eye out on any data that comes out. Keep an eye out for Fed members speaking. Markets really want to see US data start turning a little bit more deflationary. Because otherwise there is a real possibility of another rate rise. And I just want to sort of say again that, I think some of the US Federal Reserve, and probably, most importantly, Jerome Powell, have been way too dovish, way too dovish, completely ignoring January's data, completely ignoring February's data, and then, basically being forced to pay attention to March's data. It's not really a reliable way to run monetary policy, is to basically just sort of ignore data that doesn't fit your narrative. The risk with that is that, you get these periods where the market sort of catches up and you have to sort of say, oh, I was wrong. And I suspect that, Jerome's speech last week was a little bit of that. And, again, if the data doesn't deteriorate from here, I think he's going to have to wind back even further on his dovish rhetoric. And that could be a risk for markets. So we will see US GDP this week. That's going to come out on Thursday night. That is expected to show, again, fairly strong growth for the US economy in the first quarter. This is the first reading of their GDP for the first quarter, so it's the most important. And I think there is a bit of risk here. Markets will want to see probably lower than expected GDP growth. If GDP growth comes in stronger than expected, again, it just emphasizes that we're probably not going to see a US rate cut anytime soon, and I think it would be negative for both the US stock market and our stock market. Just want to add finally that our data hasn't been quite as strong as the US. Our data, we saw unemployment recently, there were fewer jobs created than expected. Our data doesn't look anywhere near as strong as the US. And I mentioned a few weeks ago, and I'll reiterate it here again, I think there's a real risk that the RBA is forced to decide on cutting rates before the US Federal Reserve does. And I think that is a big risk, because if we do cut Australian interest rates, the Australian dollar will fall, and that risks increasing imported inflation. But, if our economy slows down dramatically, it makes no sense to hold interest rates very high as well. So I do think there's a risk that our RBA may be forced to decide on cutting rates before the US, which is something they definitely, haven't wanted to do. And that could put them in a bit of the Australian economy between a bit of a rock and a hard place. So that is a sort of potential concern for the Australian market coming up, something to pay attention to, whether we're forced to at least consider cutting before the US does. Finally, I wanted to touch on company earnings. This is the big week for US company earnings. The majority of their large cap companies will report this week. Expectations are very high for this season, but a high bar is harder to exceed. So I do think there's a bit of risk this season. If earnings come in above expectations, you would expect to see some gains. This is usually a bullish time for markets, but given how high expectations are, I do think there's downside risk as well, especially after last quarter's strong results. So I would be keeping an eye on the company earnings this season for the US. There've been some big movements on some pretty sort of middling reports already. I suspect we'll see further volatility this week, either up or down. Following the US company earnings, we will see several of our large banks report earnings in the first week of May. ANZ, NAB, Westpac, and also Macquarie will all report in the next sort of 3 weeks or so. These banks do look very expensive. In fact, we had Citigroup come out and basically announce they had sell recommendations on all of the Australian banks. To be honest, and they announced that yesterday, to be honest, most of the large broking houses have had sell recommendations on our banks for a while. So I do think there's some risk around our banks in the next few weeks as well, given that their share prices do look very high up here. So let's have a look at the charts for this week. This is the US market, the S&P 500. It fell for 6 days straight, broke below 5150. It fell down to around 5,049.50, and then it bounced a little bit overnight. It wasn't the most convincing buying overnight, wasn't able to hold on to most of the gains, and finished sort of halfway, above the lows but below the highs. I wouldn't be surprised, given how much they've sold off, to see a little bit of a bounce here, and I've got a potential downtrend line drawn in as a potential upside target if they do see a little bit of a bounce this week. Like I said before though, a lot of it's going to come down to their earnings results. I would expect to see some volatile movements on the back of that, and if those earnings results aren't good, then we probably won't see that bounce from here. Looking at our own market, we have already started a bit of a bounce ourselves. From the top at the start of the month to Friday's low, we fell about 5%. We have bounced back up a little bit, but we're stalling out around resistance. Currently, I see our resistance as roughly 76.80, 76.90. If we break through that, I suspect our target would be this slightly shallow downtrend line I've got drawn in here. That downtrend line is just speculative. We usually need 3 touches to consider the downtrend line relevant, but that would be sort of what I'd be looking for if we do get a little bit more upwards movement. Overall, we are setting lower peaks and troughs now though, so after we do find a downtrend line, I would expect to see further selling, given how expensive shares look relative to the fact that interest rates are likely to remain higher for longer. So I will end it here for this week, guys. Hopefully you enjoyed. If you did, click like and subscribe. If you didn't, click it anyway, and we'll see you in the next one.